back to another episode of ACA Cast with your host this week. My name is Alex Szeto. ACA Cast is the official podcast of ACA International, the leading voice of the accounts receivable management industry. Before we start today's episode, the content is presented for general references only. In the last couple of episodes, we've been discussing about legislative trends affecting the industry in 2020. This time we want to take a broader view and take a look at what industry-wide trends that we're going to look at this year. Joining me to discuss these trends is Mike Ginsberg. He's the president and CEO of Kaulkin Ginsberg.
Hello, everyone. This is Mike Ginsberg, president and CEO of Kaulkin Ginsberg. I hope you're all doing well. I'm joined by my colleague, John Hannan, who is an analyst here at Kaulkin Ginsberg, and today we're going to discuss those topics and trends most pertinent to the U.S. accounts receivable management, or ARM industry, as we head into 2020.
So to get us started, what do you think is the most important operational trend that ARM owners should keep in mind for the new year?
I talked to a lot of ARM owners throughout the last year and going into this year. General answer to that question is, how do we combat increased labor costs, increased client pressures to produce better results at lower rates, and significant regulatory oversight while still trying to run our business profitably? So I think you could boil this down to, as we look forward here, one of the operational trends really centers around technologies going forward, because I think it's absolutely going to be even more critical than ever before for companies to really adapt their operations from a technology perspective to be able to run as efficiently as possible, maximize their production, and reduce cost as much as possible. One of the things that's going on right now in technology specifically is companies are trying to leverage multiple channels and devices all at once to ensure that they have good connection with the consumers in the marketplace. Surveys all show that consumers generally prefer email and SMS to traditional mail and phone calls, which were most utilized by third-party agencies. And while there's still uncertainty regarding compliance and the use of digital communications, the good news is the finalized CFPB debt collection rule on this very topic should clarify things and hopefully permit their usage going forward. Going forward, also on the technology front, artificial intelligence, machine learning, kind of hear those buzzwords a lot in the industry, but the goal is to make collections even more efficient and pricing models even more accurate using machines instead of live people. John, what do you think are the most pertinent economic trends that ARM professionals should think about as we begin the new year?
That's a great question, Mike. So last year, I know you guys heard a lot about fears about a recession. People are talking recession. The Federal Reserve lowered their federal funds rate because they saw weakness in the economy. But as we head into 2020, I think the data is bearing out there are reasons to be optimistic. And so I'm going to cover two economic indicators today just to give you guys a little bit of optimism going into the new year. So the first indicator I want to touch on is unemployment. So in December, the unemployment rate was 3.5%, and that is historically low. The last time we've had unemployment that low was 50 years ago. And so that's very impressive considering that we've had, trade wars that have been weighing down on manufacturing. Businesses haven't been investing as much as you would think given how great the economy has been. But unemployment has stayed really low. People have jobs, and that's great for the economy, right? When people have jobs, they can spend more, businesses have more reason to invest, and it's just so impressive that unemployment stayed so low. On top of that, we've also had really low inflation, which is surprising since usually when unemployment is low, inflation gets higher. But it stayed low, and that means that we might even have more room for unemployment to go lower. The second economic indicator I want to talk about is consumer confidence. Consumers are a huge part of the economy. Consumer spending makes up around 2/3 of GDP, about 68%. And when consumers are confident, they're going to be spending more. So what we've seen in consumer confidence indicators recently is that it stayed at a very high level, even through these trade wars that I just talked about. Consumers are staying confident, and we can sort of use that as a predictor of, short-term future consumer spending. Theoretically, consumers should keep spending well into 2020. And that's a great sign for the economy.
I must say these are all really good outlooks and really positive indicators for a growth economy and hopefully very strong performance as it relates to recoveries in the accounts receivable management industry. John, let me ask you briefly, can you talk about how things are looking in the credit grantor market that these accounts receivable management and debt collection firms service?
Absolutely, Mike. There's a ton of things I could say about each creditor segment, but to keep things brief, I'm just going to touch on financial services and healthcare. In financial services, the market is looking really favorable. Consumer credit has been growing explosively recently. We've surpassed the levels that we had before the Great Recession, which is incredible. And this is across asset classes as well. And corresponding with that, we've also seen large increases in charge-offs in financial services. Specifically in 2018, total net charge-offs were around $53 billion. It's a lot of net charge-offs. And in specific asset classes, credit cards and auto loan charge-offs in particular have risen spectacularly as well. And fintech is a new emerging market that we're looking into that's definitely worth paying attention to for arm companies. That's going to become really important as we go along.
John, very quickly, before you get off of financial services, just to be very clear with our audience here, this is a rather encompassing area, arguably one of the three largest areas if you were to pull out all of government and if you were to pull out all of healthcare. This is going to be the largest segment that remains. As John indicated, there are numerous specific asset classes, but I think the most driving ones are certainly credit cards, auto deficiencies. We focus in on fintech as well as credit unions. And I emphasize credit unions because this is very much and has been since the recovery from the Great Recession. Credit unions have been really filling the gap areas that have been left when loan originations from traditional banks dropped considerably. So if you're in that marketplace and not servicing credit unions, that's an area that you might want to focus in on in 2020. John, you want to talk about healthcare very quickly?
Yes, sir. So healthcare as a market is also poised for continued growth in 2020. The CMS estimates that national health expenditures are projected to grow by about 5.4% in 2020. And driving that down even further, out-of-pocket expenses, which is what consumers pay themselves, not counting insurance and stuff, that's also projected to grow at about 4.7% in 2020. And those out-of-pocket expenses can eventually turn into bad debt. Basically, things are going to get better, as they should, from a market level perspective. That said, hospitals and their collection practices, specifically data protection, have come under a lot of public scrutiny recently. So that is something to look at going forward. The market might be tempered by public scrutiny. There's going to be a big microscope. So that's something to look out. Now, to wrap things up, how should we feel about mergers and acquisitions in 2020, Mike?
Well, in one word, we should feel great about mergers and acquisitions right now, but the political uncertainty that's going to happen as a result of the upcoming election are really kind of pushing us deal makers to try and get as many deals closed in the first half of the year to try and reduce that political uncertainty and be able to just kind of move things along in a strong economy and a strong time for closing transactions. The markets that are attracting considerable attention right now for arm industry participants are three: commercial, healthcare, and agencies that service state and local governments. People ask about pricing. The good news, pricing for companies overall has increased. This is for established companies with some size. Let's say the middle-sized companies on up to some of the larger ones. As long as they demonstrate sustainable top-line growth and increased levels of profitability going along with that growth, these companies are not only attracting a lot of attention, they're commanding and actually receiving very competitive pricing. Also, new this year and starting last year, smaller tuck-ins have even become more desirable. What I mean by tuck-ins are companies that are generating anywhere from $500,000 a year in revenue on up to $2, $3, $4, $5 million in revenue were considered smaller add-ons in the past. Buyers overall and more generally are aggressively looking for these types of companies as they're trying very hard to increase their revenues to feed the investments that they've made in operations and infrastructure. I think that's all the time we had for today, so I want to thank everybody. John, thank you for this informative Q&A here. We enjoyed it here, and thank you all for listening. We'll look forward to seeing you the next time.
Thank you, Mike and John, for your analysis on the trends in the industry this year. You can subscribe to ACA Cast on Apple Podcasts or wherever you download your podcasts so you'll never miss a show. Thank you for listening, and we'll see you next time on ACA Cast.